So, John, let's turn it over to you now and kick us off with an update on where we stand with the Federal Reserve and the current interest rate environment.
So, well, the Federal Reserve sits at the heart of the U.S. economy and has been in the spotlight more than ever recently. From guiding the country through slowdowns and recessions to making interest rate decisions that move markets, the Fed's actions are constantly in focus, and today is certainly no different. We're about a month removed from the Fed's first rate cut since the fall of 2024, with the potential for more cuts soon. Now, at the same time, the Fed is navigating the rate cuts. It's also facing pressure from the administration, adding even more complexity to its job. So, the Fed's role of keeping the economy healthy and the financial system stable is at a pivotal point. So, to help illustrate the Fed in action, we can look back over the last 35 years at the federal funds rate as shown by the blue line. The shaded gray bars highlight periods of recession as defined by the National Bureau of Economic Research. As you can see, the changes the Fed makes evolve with the needs of the economy, reducing interest rates in recessionary periods and raising rates when the economy is running hot or inflation is spiking. You can look back to the dot-com bubble in the 90s. The Fed reduced rates to help with the recovery. Then, following the great financial crisis in 08-09, the Fed held rates at zero for 7 years to help stimulate the recovery. Conversely, in the years following COVID, the Fed was compelled to raise rates aggressively to combat surging inflation. Its efforts there have largely been successful, bringing inflation down from a peak of 9% to roughly 3% today. Now, with that progress, the Fed is taking a proactive stance, aiming to support the labor market before any material weakness emerges, leading to last month's 25 basis point rate cut.
So, John, as we think about interest rate policy, where do you envision rates may head from here?
The markets are forward looking and pay close attention to estimates released by the Fed on the direction of monetary policy. The Fed's estimates are updated quarterly and illustrate where policymakers expect interest rates to be in the future. The green diamonds on the slide represent policymakers' year-end estimates, while the purple diamond marks the Fed's long-run projection of neutral, the level at which officials expect interest rates to settle once the economy is balanced. The medians suggest 2 more cuts this year, 1 cut next year, and then 1 final one in 2027. However, when you look to 2026 and 27, the range of projections among policymakers widens considerably, reflecting differing views about the path of inflation, growth, and ultimately the neutral rate. Now, it's important to remember these figures are simply estimates based on the data today, and that data can change quickly. The Fed continues to emphasize that its policy decisions remain data dependent. But even still, these projections provide a valuable window into the Fed's collective outlook and helps guide market expectations.
John, we were talking a lot about the consumer. Help us tie together why the Federal Reserve's actions and how they impact the consumer.
So adjustments to the Federal Reserve's short-term interest rates have really broad implications for the consumer and the economy, and they really influence overall borrowing costs and setting the tone for interest rates on consumer and business loans. And given the recent Fed reduction, along with the expectation of additional cuts to come, we just wanted to give a quick visual of the impacts the Fed moves can have. An easy comparison is 2021, when short-term rates were near zero, as the Fed looked to support the economy through the pandemic recovery. That rate environment kept borrowing costs at historic lows. Mortgage rates hovered around 3%, home equity lines, new car loans around 4%. Quite simply, money was cheap. Now, fast forward to today, and the landscape looks quite different, with the Fed's benchmark rate sitting around 4%. Borrowing costs across the economy remain elevated, and mortgage rates are certainly no exception. Now, while mortgage rates aren't directly tied to the Fed's policy rate, they track longer-term yields, particularly the 10-year Treasury. Even so, The Fed's actions and tone have a powerful influence on those yields. When markets anticipate higher Fed policy rates, the 10-year yield tends to rise, pushing mortgage rates higher in turn. So while the connection isn't one-to-one, the Fed's influence still extends all along the yield curve. Now, the silver lining here is that higher Fed rates have created opportunities for savers. Yields on savings accounts, CDs, money markets are much more attractive today, giving investors a chance to earn real income on cash and short-term investments. Understanding where short-term rates may be headed can help us all make more informed financial decisions. While the Federal Reserve's latest projections can have us believe some relief to borrowers is coming, these forecasts can certainly change. Now, a return to these exceptionally low levels of 2021 appears unlikely as the Fed continues to balance a cooling labor market with persistent inflation pressures.
Jon, you talk a lot about this idea of the Federal Reserve being data dependent. What are the key numbers that influence their decision making?
Yeah, thinking about the headlines, the shifting narratives this year can feel overwhelming and quite frankly, even scary at times. But it's important to really sift through the noise and focus on what really matters. So while the headlines grab attention, our focus and the Fed remains on the data. So there's a wealth of information to digest, but the Fed zeroes in on a few key indicators, as illustrated in this quarterly forecast. The ranges shown for each data point reflect the projections of the Fed's voting members, providing insight into the factors that guide decisions on short-term interest rates. Expectations for growth, unemployment, and inflation form the core of the Fed's considerations, with other peripheral data also influencing outcomes. As you can see, the current data points fall within, or you can see in the case of GDP above these projections. Translating this to the Fed's interest rate outlook, assuming that this data holds, the takeaway is that the Fed would feel comfortable reducing interest rates. However, any significant deviations, such as higher than expected inflation from tariffs or stronger than anticipated growth, could cause the Fed to pause or adjust its easing cycle. Because the economy is constantly evolving, these projections will change over time, and investors watch them closely, using shifts as clues as to how the Fed may adjust policy. Based on current data, we remain confident that the Fed will succeed in gradually moving short-term rates lower. This environment makes fixed income yields and returns increasingly attractive relative to cash. Now, as the Fed cuts rates, expect cash yields to decline, widening the yield gap between cash and fixed income. Overall, I think, though, this environment underscores the value of bonds in managing risk and enhancing portfolio stability.
Jon, thank you for that insight into where we are today and where interest rates may potentially go.